Hello friends, welcome to day 2. First topic today is moneyness of options. Moneyness of options is very important topic. It is essential to understand this. Please remain focused. I will go very slow. I may repeat things again and again. Don't get bored. How are option prices determined? As I have already mentioned, there are different formulas to calculate price of options. Most commonly used formula is Black-Scholes formula. We do not need to learn the formula and remember it to calculate option premiums. It is not required and it is not useful. But we'll break down option pricing slowly so that we know how it is derived, and then we can have idea ourselves how to use this information. Understanding this is helpful for option strategy deployment and to carry out adjustments when required. Option price depends upon two things. First thing is price of underlying and second thing is expectation of participant. What is meaning of expectation of participants? I will tell you in a short while. These two factors combine together to determine premium on options. How? Let us see. We will continue with farmer's example. As I came to know that new development is going to be declared in particular area and price is expected to rise in 3 months by 50%. My expectation is 50% rise in market value. However, farmer doesn't know this and he just wants to sell his land at normal rate. His expected rate is 1 CR. This amount of 1 CR is his original expectation and he is not expecting any higher value because he doesn't know the news of road development. As seller doesn't have high expectation, he will expect normal rates. He will not want extra advantage. So he will ask for normal premium and not inflated premium. Why will he ask for normal premium? Because expectations are not high. How is this normal premium calculated? For now, just take my quotes for premium as rough guide. Once we go through options Greeks, it will be clear to all. So when farmer doesn't know that there is huge upside possible due to road declaration, he will sell his obligation at normal deflated premiums. Selling a call is an obligation on farmer to sell his land at contract price, that is selling a call option. We will see what is meaning of deflated premiums, don't worry. Now in another case where farmer also knows that there is a project of road which may be declared soon. What will happen now? Farmer will also expect increase in price of his property. If farmer is aware of price rise, what will he do? He will want more money for his property. That means his expectation is increasing. So will he want to sell his obligation to sell property at current rate, or he would want to price in expected price rise? Even though he is not 100% sure of the development, still he will be expecting good news to come out and increase price of his land. So definitely he would want to sell property at higher rate. He will not agree to sell contract at normal rate. He would want more money. So how can this be done? This can be done in two ways. Either he will want to increase base rate of property from 1 CR to 1.2 CR, or he may ask for more premiums on contract for right to buy at 1 CR. With increased expectation of base price, either farmer will not sell contract at all, or he will ask for higher base rate or more premium. Are you getting this point? And how much is this higher premium determined? Premium of option is determined from intrinsic value and extrinsic value. Extrinsic value is also known as time value, but in reality it is time value and volatility value. Many consider extrinsic value purely as time value and trade for theta decay, but it is a fallacy. We will go in details of what is intrinsic value and what is extrinsic value. Now let us see details of intrinsic value. Does anyone want to tell what is intrinsic value? Intrinsic value is value of given option which it would have if they were exercised today. It cannot go below 0. It is calculated as difference between strike price and spot price. Spot price means value of underlying, not its future. It is also called as current market price. For calls and puts, there is a difference. Intrinsic value of call is underlying stock's current price minus call strike. Let us see one example. I bought a call of Tata Motors 320 call bought at 12 rupees when spot price is at 315. So how much will be intrinsic value in the call? Spot price, which is 315, and strike price, which is 320. Difference between these two is minus 5. So how much will be intrinsic value? It will be 0, because intrinsic value cannot go below 0. Now spot price moved from 315 to 400. Our strike is same, which is 320. How much will be intrinsic value? Spot moved to 400 and premiums increased to 90. Now price moved from 315 to 400 and call price increased from 12 to 90. How much is intrinsic value at this moment? Spot price is 400, strike price is 320. Options premium will be, intrinsic value will be 80. 400 minus 320 is 80. Out of this 90 rupees, 80 is intrinsic value of option. Got this? Now formula for intrinsic value of put is different, because puts are negatively correlated. Intrinsic value of put is strike selected minus underlying stock's current price. For example, let us see an example. Suppose I bought put of Reliance for strike price of 2700. Premium of 2700 put is 30 rupees when spot is at 2710. Formula is strike selected minus spot price. So we'll have to make changes here. Here it will come as strike and spot. Strike selected is 2700 and spot is 2710. So how much will be intrinsic value? it will be 0 because intrinsic value cannot go below 0. So at the time of option buying, intrinsic value in put option will be 0. Now spot move from 2710 to 2500 and option premium increased from 30 to 210. Our strike is same 2700 and spot has moved to 2500. This means we have 200 points of intrinsic value. Out of 210, 200 is intrinsic value for this put option. Is this clear? Intrinsic value of call increases when spot price moves above the strike price, whereas for puts, intrinsic value increases when spot moves below the strike price. Now let's come to extrinsic value. It is commonly described as time value. Formula for extrinsic value or time value is option premium minus intrinsic value. Let's go back to the example which we just discussed. For Tata Motors, when strike price for call was 320 and option value was 12, intrinsic value calculated was 0. So here extrinsic value will be 12 minus 0, that is 12. In this example, extrinsic value will be 12 at the time of option buying. When strike price of call increased to 400, how much was intrinsic value? It was 80 as we calculated and premiums were 90. So extrinsic value will be 90 minus 80, that is 10. So at this time 10 points is extrinsic value of this call and 80 points is intrinsic value. For puts, reverse is true. When strike price for put was 2700 and spot price was 2710, option value was 30. Intrinsic value which we calculated was 0. Minus 10 cannot be intrinsic value because it cannot go below 0. So intrinsic value at this time is 0. That's why 30 minus 0 is extrinsic value. Extrinsic value of put will be 30 points at this time. When price of spot decreased to 2500 and put came into positive range, then intrinsic value which we calculated was strike price minus spot price is equal to 200 and extrinsic value will be difference of premium and intrinsic value. Here it will be 210 minus 200 which is 10 points. So at this time extrinsic value will be 10 and intrinsic value will be 200 for this put option. Are these calculations clear? Is there any doubt? Extrinsic value has two components. One is time component. Time component is calculated from time of contract writing to time of expiry. Longer the time from date of writing contract to date of expiry, more is the value of option. This fact is same for calls as well as puts. More time to expiry means more time value. Other factor affecting extrinsic value is volatility. Higher the volatility, higher is extrinsic value. Just remember these facts for now. We will discuss this in detail when we come to option Greeks. Other Greeks do not contribute to time value. They determine change of option price with respect to change in spot price. Now let us have some exercises on this part. It is important to know whether everybody has understood or not. Please let me know who has understood this. Show your thumbs up in chat box. Then we'll open option chain and go ahead with exercise. After the exercise, we'll come back to Moneyness part again.